Surging long-term yields, a divided Federal Reserve, and a suddenly fragile AI complex are forcing equity markets to reprice risk. Welcome to vTalkInsight, Equity Pulse Daily for July 30th, 2026. We will unpack how policy ambiguity, energy shocks, and shifting earnings leadership are reshaping the risk and reward profile across global equities. Equities are trading against a policy backdrop that looks stable on the surface, but is far less settled underneath. The Federal Reserve kept the funds rate in a 3.5 to 3.75% range and reiterated its 2% inflation target, yet three regional presidents argued for an immediate hike, making the split inside the committee hard to ignore. That mix of a formal pause and open dissent has left markets unusually unsure about what comes next. Implied odds for another move have swung sharply, and many desks describe this as one of the most difficult decisions to handicap in decades, not least because the Fed has stepped back from detailed forward guidance, forcing traders to infer its reaction function from data and dissents. Rates markets are filling that guidance gap. Nominal and real Treasury yields have pushed sharply higher since the last meeting, with some of the largest between-meeting shifts in 20 years, and 30-year yields now sit about 11 basis points higher, above 5.1%, while 2-year yields fell after the decision, producing a pronounced bear steepening of the curve. For equities, that steepening is de facto tightening, even with the policy rate on hold. Long-term borrowing costs are rising for governments and for capital-intensive issuers, from hyperscale data centers to infrastructure, while credit spreads in technology and other growth sectors are widening, with some investment-grade names now trading at levels more typical of lower-rated borrowers. Price action is starting to reflect that stress. The S&P 500 fell around 1.5% in the latest session, and the VIX has moved back above 20, even though risk assets initially bounced on relief that there was no surprise hike, highlighting the tension between a steady policy rate and tightening delivered through term premia and credit. The implication for equities is a tougher environment for long-duration growth stories and more sensitivity to any disappointment. Sectors whose cash flows sit furthest into the future, especially large-cap technology, now face a double test on earnings and capital discipline, and that is a key backdrop for the sector rotations and stock-level reactions we are seeing across the tape. Geopolitics is adding a fresh layer of uncertainty, primarily through energy markets. Escalating tensions in the Middle East, including U.S. and Saudi retaliatory strikes, Iranian missile attacks on U.S. forces, and interference with tanker traffic through the Strait of Hormuz and the Red Sea, have brought an abrupt end to the recent period of relative calm. Brent crude has snapped back into the high 80s to low 90s, with daily moves of 3 to 5% now common. That volatility is embedding a persistent risk premium into crude and refined products, and it is already influencing inflation expectations and central bank scenarios, even if policymakers still tend to treat the latest spike as temporary. The earnings tape is starting to show the transmission from geopolitics to margins. Procter & Gamble, for example, is flagging roughly $1 billion of after-tax drag this year from higher input costs tied to oil prices and Middle East conflict, a 6 to 8% headwind to earnings even as underlying demand for its brands holds up. At the same time, higher prices are supporting producers and resource-heavy markets. Energy and basic resources are outperforming in Europe, lifting indices such as the FTSE, and miners like Rio Tinto are benefiting from stable iron ore prices supported by export-driven steel demand, highlighting how the shock is redistributing earnings power across sectors. The broader risk is a shift in correlation regimes. Cross-market equity correlations have been unusually low in recent months, but a combination of Fed uncertainty and further escalation in U.S. Iran tensions could flip that, pushing equities, credit, and commodities to move more in tandem and amplifying directional swings rather than offsetting them. The most visible pressure point from higher discount rates and policy uncertainty is large-cap technology, especially the AI infrastructure complex. The S&P 500 has slipped below its 50-day moving average and key short-term support, while the Nasdaq 100 is already more than 10% off its highs, with technical work still flagging several more percentage points of downside before major support. Positioning is adjusting quickly. Portfolio managers are reducing risk by cutting longs and covering shorts in semiconductors and high-multiple software after an exceptional run, and some describe what they see in parts of the Nasdaq as capitulation rather than orderly rotation, even as they frame this as a mid-cycle correction within a broader bull market. At the heart of the repricing is the AI Capex supercycle. Hyperscalers are on track to deploy on the order of $750 billion on data centers, networking, and advanced chips this year, and the market has shifted from rewarding sheer growth to interrogating whether that spending can deliver timely productivity and monetization gains. Valuations across the complex are now unforgiving. Companies that beat on revenue but surprise with higher expenses or capital intensity are being punished, as seen in the negative reactions to strong numbers from SoFi and to SK Hynix's combination of a profit surge with a roughly 50% increase in Capex guidance. Microsoft currently sits on the stronger side of this divide. Azure revenue grew about 43%, ahead of expectations, taking the cloud business to an annualized run rate above $100 billion, while paid seats for Microsoft 365 Copilot jumped from roughly 20 million to 30 million in a single quarter, underscoring rapid enterprise adoption of AI tools. Meta offers a sharper reminder of the risks from aggressive investment. Its operating margin has dropped from the low 40s to the low 30s year-on-year, with total costs up more than 50% and free cash flow nearly disappearing as AI and infrastructure Capex accelerate, even as ad pricing grows at around the mid-teens pace. In semiconductors, the tension between growth and expectations is just as acute. SK Hynix reported operating profit more than 5 times higher than a year ago, yet missed an elevated bar and paired that with a sharp Capex increase, triggering double-digit intraday swings in the Kospi, multiple circuit breakers, and enough volatility to prompt Korean authorities to focus on curbing risk from leveraged exchange-traded products. Set against that, demand for AI hardware remains robust. ARM Holdings is seeing data center royalties more than double year-on-year, and appetite for its latest chip designs and for equipment from suppliers like ASM International is strong enough to support higher guidance, but the market is now insisting on clearer evidence of capital discipline, sustainable margins, and resilient supply chains before paying peak multiples. Outside the AI complex, the earnings picture is considerably healthier and leadership is broadening. In the U.S., this season marks a 7th straight quarter of double-digit earnings growth, with the latest quarter tracking close to 27% year-on-year, while Europe is on course for roughly 17% growth, one of its strongest seasons in years, with about 3/4 of stocks outperforming the main indices. Banks are an important pillar of that resilience. UBS has reported a 53% jump in equity trading revenue, strong wealth management inflows, and a $3 billion share buyback, while Standard Chartered and Deutsche Bank have also beaten profit expectations, and European banks more broadly are benefiting from higher rates and active trading, even if their share prices still lag U.S. peers. Cyclicals tied to commodities and real assets are also contributing. Rio Tinto has posted a significant first-half profit increase on the back of steady iron ore prices supported by export-driven steel demand, and copper is outperforming gold thanks to robust physical demand from the U.S. and China, data center expansion, constrained supply, and emerging weather-related risks. Infrastructure and energy transition beneficiaries add another durable leg to the story. Bloom Energy is seeing strong orders from data centers, and Bureau Veritas has raised its growth targets while acquiring Lotus Works to deepen exposure to mission-critical assets like data centers and semiconductor facilities, even as it divests legacy oil and petrochemical activities, aligning with multi-year demand for resilient, inflation-linked cash flows. Consumer-facing names round out the picture with a clear split. Starbucks is delivering nearly 8% same-store sales growth and stronger guidance. Chipotle has lifted its full-year comparable sales outlook, and Kering has rallied on evidence of a Gucci recovery, while Procter & Gamble's cautious guidance and broader luxury sector pressure underscore how higher energy costs and uneven regional demand are creating winners and losers within the consumer space. Putting it all together, equities are navigating a tricky intersection of a divided but still hawkish Fed, a powerful yield shock at the long end, and an AI Capex supercycle that is now being judged on hard returns rather than narratives. At the same time, earnings breadth in the US and Europe, stronger banks, resilient commodities, and infrastructure and energy transition themes are providing alternative pillars of support as leadership rotates away from the most crowded technology expressions. From here, the key signals to watch are the behavior of long-dated yields and credit spreads, any change in Fed communication around its reaction function, the trajectory of AI-related Capex at hyperscalers and chipmakers, and the path of oil prices as Middle East tensions and shipping disruptions evolve. Those forces will shape whether this remains a contained correction within a broader bull market or morphs into something more disorderly. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.